Many companies accept credit card payments from their customers. It's easy and convenient for customers, and unless there are problems, it ensures that the business collects quickly from the customers. In this video, I'll walk you through a real-world credit card flow and reconciliation process, from how credit cards are processed, the role credit card processors play, how to record sales invoices paid with credit cards in batch or separate, and how to ensure that all credit card amounts make it into your bank account. While every company has its own procedures, the concepts will cover multiple payment sources, different card settlement dates, merchant fees, chargebacks, and maintaining a complete audit trail apply to most businesses. There are a few decisions to make when you accept credit cards from customers. First, the business has to decide the types of credit cards to accept. For instance, Visa, MasterCard, American Express, and perhaps other payment methods such as PayPal. Next, the business has to decide who's authorized to accept and or process customer credit card information. Now, in a retail store, customers swipe their credit card, and in a restaurant, the waiter takes your credit card or brings you a credit card machine to swipe your credit card. Most of you are familiar with those situations. However, many companies also have an online store where customers can complete the sales transaction and pay by credit card. Either the business manages the online store, or you could have a vendor manage all aspects of invoicing and processing the credit card payments. But be careful in selecting a vendor and ensure that you check the related SOC reports each year. There are stories like the one involving Digital River, where the company just closed down and didn't pay the money owed to the companies that had contracted with them. In many businesses, the sales team also processes orders and the related credit card payments, and so does the accounting team. Third, you have to decide what process to use to record sales invoices and payments for credit card customers, individually or in batch. And then finally, the business has to put in place processes for the reconciliation of the invoices and payments and how to manage chargebacks. Let's take this company, for example. The business's sales team and accounting team accept credit cards from customers, and the business also has an online store. Let's focus first on the sales team and how it handles credit card transactions. The salespeople process orders from established and large customers in the customer relationship management system, for short CRM, like for instance Salesforce. These large and established customers buy frequently, have a credit limit with the business, and are billed typically on net 30-day payment terms. Sometimes, though, customers place an order that is more than their credit limit, and in those cases, not to hold up the order, the customers want to pay the new orders with the credit card. It happens. So in such a case, the salesperson sends the customer a credit card payment link that allows the customer to enter their credit card information via an online payment form. The salesperson never sees any of the credit card information, so it's very secure. If the credit card payment is approved, the sales team is notified of a successful payment, and the order can be processed in the CRM. The second type of transactions that may involve the salesperson are high-volume transactions for small customers. Some of the customers will perhaps buy again, and others will not. They don't have a credit limit or would likely not be approved by the company to buy on credit, and that is why these customers also pay with a credit card. This is somewhat like a customer buying products at the front sales counter. The salesperson processes the order in the CRM, so there is a detailed record there. And just like with the other customers, sends a credit card payment link to the customer, and if the credit card payment is approved, the salesperson releases the order. Again, very secure, because the salesperson never gains access to the credit card information, and that protects both the salesperson and the customer. Here comes the important part. What differentiates these two types of customers is how we record the sales transaction and subsequently the credit card receipts in the accounting system, the ERP. Your CRM, like for example, Salesforce, may be integrated or interface with your ERP, meaning that all completed orders convert into sales invoices, and then these sales invoices flow into the ERP automatically. But sometimes there isn't an automatic interface, and the accountant has to import the daily sales from the CRM. Having worked for many different companies, I'm no longer surprised by how many systems are stitched together manually. Either way, the ERP can only accept the sales invoices if the customer is already set up in the accounting system. So if you have new customers, you need to set them up first in the ERP via an automated process or manually, and then interface or load the sales transactions. Now think about it. Would you really want to set up a new accounts receivable account for every single small, potentially non-repeat customer, and then record and post a credit card payment one by one for each of these high volume transactions? Probably not. So let's talk about the approach that I've used in the past and take a little detour before we continue on with the credit card information processing. Here's an example of a daily sales invoice register from May 1st, 2026. The sales register shows us the invoice number, invoice date, customer name, payment terms, sales amount, sales tax, and a split of the sales amount by product A, B, and C. And we can also see how the sales amount is distributed by payment type, net 30 days, Visa, MasterCard, and Amex. You could have additional payment methods like for instance, PayPal. In the invoice column, a number column, we have two types of invoice numbers. One for net 30-day customers, meaning large established customers with credit limits. There are 7 invoices for these types of customers on May 1st. And looking at the sales amount column, you can see that the sales amounts for these customers are large and range from about $5,900 to nearly $15,000. The second type of invoice numbers for the small customers, those customers without a credit limit. Those invoice numbers start with CC, and we can see that the sales amounts are very small, ranging from $53 to $212, for a total of $1,537 in sales for credit card customers. So we'll use this sales invoice register example to record the sales invoices in our ERP. Now, if you can interface your transactions, you would probably try to set it up in the same way. Because another consideration for not recording every single sales transaction in your ERP is how the business's accounting software is priced. Many accounting software programs are sold as a subscription, and the price varies among other factors based on the number of transactions you record in your ERP system. So if you record each small sales credit card transaction separately, you'd end up paying potentially a lot more for your accounting program subscription. So for this sales invoice register, we would record each transaction for the large established customers and one summary transaction for the credit card sales. So let's look at what we need to do. In the accounting system, there is typically a specific screen where the accountant would input or import the information for each sales invoice. And that would result in an accounts receivable journal entry, like for instance, for Summit Sporting Goods and invoice 1001, with a debit to the AR subledger account for Summit Sporting Goods for $13,224.56, and credit sales tax payable for $748.56, and a credit to the sales revenue accounts for product A, B, and C for $2,951, $2,109, and $7,416, respectively. The accountant would repeat an entry for the other large customer accounts as well. Now, for the credit card transactions, rather than debiting an AR subledger account, although you could set up one single AR subledger account for it if you wanted to, my preference is to debit the unposted credit card clearing account separately for Visa transactions for $318, MasterCard transactions for $795, and Amex for $424. And then credit sales tax payable for $87, and the revenue accounts for products A, B, and C. The reason for posting each receivable separately for each credit card type, Visa, MasterCard, and Amex, is that each may be received into the business's bank account separately. If the company has older credit card contracts, the Amex credit card amounts may settle at a different time than the amounts for Visa and MasterCard. So adjust the posting based on how the amounts settle. That will make a huge difference in trying to reconcile the credit card receipts. We're back to our customer credit card receipt process flow and ready to talk about the role that the accounting team plays in terms of credit cards. Depending on the business, the accounting team communicates with customers after sales invoices have been recorded and posted in the ERP. Maybe an invoice is past due and the accounting team accepts a credit card payment as an exception for payment of a past due bill. You don't really want to make it a habit because the customers in that case has already received free credit because they haven't paid within the net 30 days, and it costs the business a fee to accept the customer's credit card. Nonetheless, sometimes it's just better to pay the extra fee to ensure that you receive the money from the customer. You can always reduce their credit limit afterwards and put the customer on prepayment terms in the future. Accounting has the option of either processing the customer's credit card or sending a payment link to the customer. For our sample company, let's say that the accounting team processed a credit card payment for customer pro team for $1,500 for invoice 997. Whether the sales team or the accounting team processes the payment at the end of the day, a daily batch is submitted to the credit card processor. The accountant should download a daily detailed batch report so that the accountant can match up the amounts from the daily detailed batch report to the daily sales invoice register to ensure that all payments show up on the batch report. Our total for this credit card batch detail report is $3,037, which is $1,537 in credit card transactions for credit card customers and $1,500 for the pro team customer with an established account. It's very important that you match up the amounts so that you know how to record them. In this case, we've already recorded the expected credit card receivables for credit card customers to the unposted credit card clearing account. And now only need to reflect the credit card payment from Pro Team as well. The accountant posts a debit to the unposted credit card clearing account and a credit to accounts receivable Pro Team for $1,500. That removes the amount from the AR aging report and stops the collection process since the business is only waiting on the credit card processor to send the amount to the business's bank account. This is then what the company shows in its general ledger account for the unposted credit card clearing. The 4 transactions are for the 3 sales invoice transactions for Visa, MasterCard, and Amex, as well as the credit card payment from the Pro Team customer for a total of $3,037. Once you submit the credit card batch, the credit card processor like Stripe and Square handles the approvals, settlements, deducts the merchant fees, applies chargebacks and adjustments, and then deposits the net funds into your bank account. Large traditional banks also offer merchant services. There's a delay, though, before the deposit is credited to the business's bank account, unless you pay extra fees for same-day funding or instant payouts. Most businesses, though, wait a day or two before they receive the funds. Now, it's important to understand that the credit card amounts the company processed are likely to show up at different times. Visa and MasterCard within 1 to 2 days, Amex 3+ days. Thus, the credit card processor deducts merchant fees, and if you have chargebacks because a customer disputed a credit card charge, those will be deducted as well. Also keep in mind that the average processing fee for Visa and MasterCard is around 2.2%, and Amex averages around 3%. The business's rate depends on the type of transactions, online versus face-to-face, industry, number of chargebacks. So let's see what happens to the May 1st credit card transactions. The bank statement for our company shows 2 deposits, one for $2,348.74 and one for $411.28 for a total of $2,760.02. However, those amounts don't seem to match up to what the business had in its unposted credit card clearing general ledger account, which shows $3,037. And that brings us to the point where the accountant reconciles the bank deposit with the batch detail report, the general ledger, and the merchant statement. We start by listing the credit card amounts we expect to receive for the May 1st credit card transactions, which are Visa, MasterCard, and Amex for $3,037. We first subtract the merchant fee of $64.98. I assume 2% for Visa and MasterCard and 3% for Amex. The credit card processor also communicated a chargeback for a customer, which was subtracted from these credit card transactions. Once we subtract the merchant fees and the chargebacks from the amount submitted, we arrive at $2,760.02, which equals the 2 deposits of $2,348.74 and $411.28. If you still have variances that you can't identify, I recommend that you look at the settlement reports that the credit card processor provides. The next step for the account is now to record the necessary accounting entries. First, on May 5th, we debit the Pacific Coast National Bank General Ledger account for $2,348.74, the amount that is shown on the bank statement. We debit the merchant fee expense account for $52.26, which are the merchant fees for Visa and MasterCard. We debit the general ledger account for customer NSF chargebacks, receivables for $212, and we credit the unposted credit card clearing account for $318, $795, and $1,500. On May 7th, we debit the Pacific Coast National Bank General Ledger account for $411.28 for Amex, debit the merchant fee expense account for $12.72, and credit the unposted credit card clearing account for $425. It's important that someone is assigned to handle the chargebacks follow-up. The business needs to understand why the amount was charged back. Is this a fraudulent case, or sometimes the customer doesn't recognize the description on the credit card statement and disputes the charge? So the first thing to do is research the chargeback by reviewing the credit card processor's reports for more information. At the beginning of the video, I mentioned that many companies also have an online store or e-commerce platform, which is often managed by a vendor, like, for instance, FastSpring, Paddle, or Verifone. In that case, the vendor is considered a reseller and completely manages the online store, including sales tax, for a flat fee plus percentage of the sale. Depending on the setup and plan the business chooses, the vendor pays the business weekly, bi-weekly or monthly. And the amount that is deposited in your bank account represents the sales amount the vendor processed less the fees the vendor charges. For our online store, let's assume that the company deposits monthly and the sales amount per the vendor's settlement reports for the month of May 2026 are $52,971 minus fees of $3,973. The vendor reports typically provide a breakdown by products, and that is what we're using here. The vendor won't pay the business until after the month close for May 2026, and that is why we need to record the receivable. We debit the online store receivable general ledger account for $48,998, the amount we expect to receive once the vendor remits the payment. We debit the merchant fees expense account for $3,973, and then we credit the sales accounts for products A, B, and C for a total of $52,971. Please keep in mind that strong internal controls are very important for every business that accepts credit card payments from customers. Only authorized employees should be able to process customer credit card payments, and employees should never record or store customer credit card information outside of an approved payment system. This helps protect both the customer and the company while supporting PCI compliance, which is the security standard for the credit card industry. Each day, the accountant should reconcile the sales register to the credit card processor's batch report to verify that every approved customer payment was submitted for processing. Once the processor settles the transactions, those settlement reports should be reconciled to the bank deposits, adjusting for merchant fees, settlement timing, and any chargebacks. Finally, the credit card clearing general ledger account should be reviewed regularly. It should contain only transactions that have been processed but have not yet been deposited into the bank. Older outstanding balances are often an indication that something requires investigation. As you've seen, reconciling customer credit card payments is much more than simply matching deposits on a bank statement. A well-designed process creates a complete audit trail from the original customer transaction all the way to the final bank deposit. By separating transactions by payment source and card type, maintaining a credit card clearing account, and reconciling the processor reports, merchant fees, chargebacks, and bank deposits, you can quickly identify missing payments, recording errors, or unusual activity before they become larger problems. Every company's process will be a little different, but the objective is always the same. Make sure every authorized customer payment is properly recorded, every dollar reaches the bank, and any differences are identified and resolved promptly. If you found this walkthrough helpful, I'd appreciate if you would like the video and subscribe to the channel. I regularly share practical accounting processes, reconciliations, internal controls, and real-world examples based on my experience in corporate accounting. I'd also love to hear from you in the comments. How does your organization handle customer credit card reconciliations? Do you use a clearing account? How do you manage merchant fees, settlement timing, or chargebacks? Sharing your experience helps all of us learn from one another. Thanks for watching, and I'll see you in the next video.